Joining me right now, along with Hank, is Jason Pride of Glen Mead, Peter Schiff of Euro Pacific Capital, and our own Bob Pisani. Good to see everybody. Thanks for joining us. Peter Schiff, let me kick it off with you and get your take on what's going on in Cyprus right now. What's the impact?
Well, a lot of people are hoping that what happens in Cyprus stays in Cyprus, but, I wouldn't be so sure. I think bank depositors, including depositors here in the United States, have to be concerned about the value of their deposits, because if we have a major bank failure in the United States, there's no way the FDIC has the money to cover the potential losses, and so we would have to have a huge bailout like TARP. And where would the money come from? And even if there is a bailout and the Fed has to print money, the losses to depositors through inflation will be far greater than what the Cyprus depositors are losing due to this tax.
Hank Smith, it is pretty extraordinary that that the depositors would have to pay for a bailout that they didn't even necessarily authorize. What do you think about what Peter said? Is this a recipe that would be used elsewhere in the world?
Oh, I highly doubt it, Maria. Look, and I think we should take great confidence in our banking system now compared to where we were 4 or 5 years ago. Our banks are very healthy. TARP was a good thing. It protected the financial system and the confidence in the financial system. And our banks are in great shape, earning their way out of...
They're in the worst shape they've ever been. If there are a few interest rate hikes away from insolvency. That's why the Fed is keeping rates at zero.
Wait a second. Peter, you're saying that the banks are a couple of interest rate points away from insolvency?
Why do you think when the Fed did the stress tests, they didn't ask the banks to stress test a collapse in the bond market? They only looked at the stock market or maybe real estate. But when interest rates rise substantially, the major banks are going to fail. Their balance sheets are not going to be able to handle it.
And how do you explain the billions plus in profit that J.P. Morgan made last year? How do you explain the capital levels on the balance sheets of all these banks that are way above even Tier 1 capital, which is the Basel regulation?
Maria, they're speculating with cheap money. When the cheap money goes away, the losses are going to be there. They're going to be enormous. What do you think is going to happen to these bond portfolios, these portfolios of real estate loans? What's going to happen when the Fed finally takes the punch bowl away and lets interest rates go up? And it's not only the banks. The U.S. government can't pay interest on the debt when the rates go up.
Now, look.
Maria.
Yes.
Hi, Maria. This is Jason Pride. I don't really agree with what your other guest here is saying. The banks have greatly improved their financial condition. Yes, It's cheap money, but the cheap money's here. It's going to be here for quite some time. What I do agree with him is the Cyprus issue is something to watch. This is an example of policy mistake. We are still in a period of deleveraging. Policy mistakes can happen. Spain itself has to refinance 20% of their GDP in new debt issue this year. That's a lot of money to actually have to issue to the markets, and there are more than enough opportunities for missteps by policymakers, which is what we're seeing the reaction to today in the markets.
Remember, their first mistake, though, is to even insure the deposits in the first place. That's a big problem. Government should not insure bank deposits. That's a tremendous moral hazard. That is one of the main reasons that the banks make reckless loans, because the depositors don't care what the banks do with their money because the government's there.
That's one of the guardrails to oversee these banks.
No, but we don't need it. We didn't always have it, and there are other nations that don't have any deposit insurance, and their banking system is much sounder than ours.
Right, and they're asking depositors to pay for the bailout.
No. There are no bailouts in those countries. The countries that don't have deposit insurance have a healthier banking system. Because we have this deposit insurance, American depositors don't care how reckless their banks are. And the banks don't care because the depositors don't care. So it's a terrible system, and eventually it's going to implode. And people who have money on deposit in U.S. banks are going to take huge losses one way or another. Either they're going to lose their deposits, or their deposits are going to lose value because of all the inflation that's going to have to be created to bail out the banks.
Hank, you own bank stocks. Are you not worried about this?
No, and in fact, in a rising rate environment, as long as rates don't spike up dramatically overnight, in a rising rate environment, banks are going to make more money and become even stronger and healthier. And we own two of the highest quality banks in the world, J.P. Morgan and Wells Fargo, and we're very pleased
their customers can't, the borrowers can't afford to pay the higher rates. And what's going to happen to the value of their existing collateral when interest rates spike? And eventually they're going to spike because the Fed is waiting far too long to raise them. And so when rates eventually rise, they're going to rise much faster and much higher than anyone believes.
Bob Pisani, you're not really seeing the impact. Go ahead, sir. You go ahead, Jason.
Sure. I'll add in here. I don't fully agree with what your guest is saying here as far as immediately rising rates and banks falling apart. Having said that, I think the world has changed, and we have to recognize the big picture here. Number one, bank business models are not the same they used to be. They're not the great investments that they used to be. And number two, as far as the overall economic situation is concerned, whether you're looking at bank debt or government debt, we have too much. Somebody has to pay for it. Right. We have to introduce austerity to the system. We have to introduce bank write-offs. We have to bring the system back to a more normal state. That's going to take a long time to repair. It's going to hold growth down for a considerable period of time, and it's going to make the likelihood of policy mistakes higher than they are normal.
And that's why what happened today was very important. Everybody agrees it was a blunder to include insured depositors and having to pay for part of this.
I don't agree it was a blunder.
Well, all right.
The depositors are going to pay one way or another.
Well, fine.
And they're not innocent bystanders.
I apologize. I think it's a blunder to include them, okay?
But remember,
however,
depositors are creditors.
They are unsecured creditors. Thank you.
That's
I think you were going that way. I agree with that. And what this is today is an indication, a shot across the bow, that unsecured creditors like depositors may be drawn into this. I think other countries will leave out the insured depositors part of this thing, but other ones above that, I think there may be fair game in the future.
But it's better than hitting taxpayers in general who didn't put money in these shaky banks, or just creating inflation, just printing a bunch of money to pretend there are no losses, but pushing the losses on the currency so that prices go up and the deposits lose value.
I agree. Depositors above those who are insured can be held responsible and may, in fact, be held partly responsible.
All right, gentlemen, we got to jump.